All right, so ladies and gentlemen, welcome everyone on this fine Saturday morning to the Oligarch Roundtable. It is my pleasure to introduce a guy who I really respect to you all, the face of DeFi, the man, the myth, the legend, Mr. Durden from Lifinity. Durden, how are you doing?
Hey guys, I'm doing pretty good.
Love to hear it. Thank you for hopping by. We're stoked to have you. So, let's start with the beginning of the story. How did you get into crypto to Solana and finally Lifinity?
Sure. Yeah, and I forgot to say thanks for having me on. So crypto I got into in 2017. Started off just buying some Bitcoin and eventually bought some Ether and then a couple ICOs, I think. And that was like near the end of 2017. So that cycle came to an end soon after. I'm just like held on to my assets and waited for the next cycle. And in the next cycle, I started doing some like very basic things in Ethereum DeFi. But as many of you might know, it's like pretty cumbersome. Just like high high transaction fees and things are slow. Then I heard about Solana, and I'm not a dev, but I did read their like you guys might know like the article where it like talks about the eight core innovations of Solana, which is like semi-technical. I do have a math background, so like I read that and like that kind of thing does appeal to me. So I was like, okay, this sounds pretty interesting. So I actually tried it out, and it worked as advertised, like super cheap and fast. So I was like, this is cool. So then I started using Solana DeFi. I think I started on Radium, just like provided liquidity, and there was like pretty significant liquidity mining rewards back in those days. So yeah, I got in that way, and then just like gradually started using other protocols as well, and never really looked back. In terms of Lifinity, uh, Lifinity was another protocol I was looking into. So I was in their Discord asking questions a bunch, and then one day the team asked me to join them as I think originally just as a mod, and then but after like a month or maybe less, they're like, we want you to join us as a core team member. So yeah, so they were like building Lifinity for about 6 months before I joined them. But yeah, now I'm one of the core team members, and I've been with them for about 2 years. It's been a pretty wild ride, but yeah, it's been fun.
That's an insane story. I think many people actually think you're one of the founding members because you've been with them for so long and you have posted so long. But it's good to know that you are a co-contributor who joined as they were moving forward with their journey. I actually wanted to ask about your background, but now I got it. You mentioned that you have a maths background, so numbers guy. Good to know. And I also heard, I think it was a podcast that you played semi-professional poker. Is that right?
Yeah, I was playing poker semi-professionally for like 3 to 4 years. I only played. Oh shit! Well, it's been a while. What are they called? Heads up, uh, heads up, hyper sit and goes. So like it's basically one on one, and the starting blinds are 25, which is like
Okay.
very low. So like each game ends really quick, and it's like it's the type of poker that's the most amenable to mathematical analysis. So basically, when the blinds are as low as 25, uh, the strategy space is that much smaller, so it becomes possible to calculate the optimal strategy for the game from like the very beginning of the game. And for more complex forms of poker, like full ring, where there's like 9 players, you can't do that. Actually, there actually don't even exist, quote unquote, optimal strategies for multiplayer poker games. And so, anyways, like Heads Up is like it's the most mathy type of poker. So it appealed to me, and yeah, that's the only thing I played. But yeah, that was a totally different era of my life.
Yeah, super interesting journey of yours. We have quite a few poker players in here. I guess we should soon host the Affinity X Oligarch Grand Poker Tournament, one-on-ones. We'll see what the future brings. But yeah, also, as far as I know, Affinity has an actually small team compared to the level where you guys operate at. And super interestingly, you guys are also anonymous. Could you give us a rundown on how the team is looking?
Sure. So yeah, we're anonymous. Let's see. So we're composed of just four of us. There's me, and then we have two devs, Luffy and Zoro. They have been devs for their entire working lives for tens of years, I believe. So they have a lot of experience. They did some market making before they started building Affinity, so they have some like experience, like relevant experience before they started building Affinity as well. And then our last team member is Maki. They are the artist or designer, I should say. So they do anything design related. And then me, I'm I don't know, I'm like the face of Affinity, I guess. I do like everything that's not development or design work. So like marketing, communications, community management, stuff like that.
You are indeed the face. I think many people associate Affinity with you, which is a good thing. It's a pleasure to see a bunch of chats operating at such an effective and high levels, which others can only imagine with enormous teams and fundings. So, Affinity, I like to find out as simple as possible. How do you explain Affinity to someone who has been in the space but never had the chance to take a deeper look at what you guys do?
Yeah, so let's see. So the one-liner is that Affinity is an Oracle-based DEX that's designed to improve capital efficiency and reduce impermanent loss. Affinity is a very unique DEX. There's many things about it, from the design of its DEX to its tokenomics, that make it um, very different from your average DEX. Um, so like it's kind of hard to know like where to start, but I guess I'll just start from the DEX. So it's an Oracle-based DEX, like I said. Um, so what this means is that usually most DEXs, they determine the price purely based on the balance of assets in their pool. That's true for constant product market makers and also for concentrated liquidity market makers, and also stable swaps. They all work that way. But Affinity is different. Its starting point for how it determines what price to trade at is the Oracle price. And based on the so Affinity also considers the balance of assets in its pools, but instead of using that as the starting price, it just uses it as a data point for how to adjust the starting point, which is the Oracle price. And so practically what this means is we are trading at the average centralized exchange price, you might say. And the reason this is useful for us to do is because price discovery tends to happen on centralized exchanges. And maybe in more easy to understand terms, what that means is that if the price of an asset moves significantly, statistically, that's more likely to happen on a centralized exchange than it is on a decentralized exchange. And what happens when you don't, when you aren't the place of price discovery, where price discovery happens elsewhere, then you will get arbitraged. And this is what happens to other dexes, right? Like they have no way to update their prices based on information, the price information on centralized exchanges. So that means there's this arbitrage opportunity. So for example, like say the price of Sol is $100, and then someone does a massive centralized exchange, price goes to $101. Um, a standard DEX won't know that this happened, so its price is still $100. So then what arbitragers can do is they can buy SOL on a decentralized exchange for $100 and then sell it for $101 on a centralized exchange, profit that way. But they can't do that with Lifinity because as soon as the price changes on the centralized exchange, Lifinity knows that this happened, so it updates its price, and so it doesn't get arbitraged. And what that means is that Lifinity, unlike the other dexes, is not selling its SOL at too cheap a price, the $100 that is. Instead, we're at $101. And so actually what happens here, normally, if Lifinity didn't exist, the arbitrage would be between the DEX and the centralized exchange. But because Lifinity does exist, it's much easier for arbitragers to do the arbitrage atomically, fully on chain. It's easier because they can guarantee, they can design the transaction such that the arbitrage only happens, both sides of it, the buy and the sell, if and only if both transactions go through both exchanges. Whereas you can't have that guarantee if you're doing it on a centralized exchange. Like the trade might go through on the centralized exchange, but then not on the decentralized exchange because some other arbitrager got to it before you did. But then you already sold on the centralized exchange, so now you have to buy again, but you have no arb and you just paid fees. So, anyways, I know I'm like going down a bunch of rabbit holes, but yeah. So I think that's the most fundamental thing about Lifinity is that it's an Oracle-based DEX, and the practical consequences of this is that we are much more profitable because we're able to avoid this toxic flow that is that arbitrage thing I explained, which in more it's more often referred to as impermanent loss. And actually, we're able to reverse this into what we call market making profit. So usually, impermanent loss, like another way to explain it, is that you are buying high and selling low, and that ends up uh, generating a loss. But instead, because we use the Oracle price, we're able to buy low and then sell high. So that generates a profit. And it's a profit that's totally separate from trading fees, which of course also generates a profit. But on other dexes, that's normally all there is. There's just a trading fees, and you hope that that is greater than the impermanent loss that you suffer. For us, we're able to generate both trading fees, and on top of that, generate a market making profit. And that's all thanks to using an Oracle. I guess I'll stop there for now.
Super, super interesting. And don't be afraid to dive into separate rabbit holes. We are all in for that. And it's very good to know how Affinity avoids impermanent loss and this, MEV arbitrage and toxic flow. It's rare that we see something like this, and it's bad to see other dexes getting, sort of abused for this arbitrage opportunity. Uh, but this is a lot of management. Do you guys have algorithms and bots to do this for Affinity?
Sort of. So, I guess one clarification, just in case there is any confusion. Lifinity doesn't execute any trades, or I should say, Lifinity doesn't initiate any trades. Lifinity is just providing liquidity for traders to trade against. So there are no like bots that are, I don't know, like executing a trading strategy or whatever. We're just providing liquidity. Um, I forgot why I said that.
Well, I also heard that this is a service as well, right? You guys providing liquidity.
Yeah, I guess that's probably a good jumping off point to another thing that makes Lifinity unique. So the way DEXs usually work is that the DEX is just like a protocol, and then users can come and deposit their liquidity in a pool, then earn fees, and then withdraw whenever they want, type of thing. Um, a major difference about Lifinity is that Lifinity owns all the liquidity that it provides. So it has protocol owned liquidity. This might be a first for a DEX. I'm not really sure. I haven't really heard of any other cases, but it's extremely useful for a DEX to own its own liquidity. The main reason is that, oh yeah, I guess I also mentioned that. So normally on other DEXs, the way that a DEX generates revenue is that it charges a fee on the trading fees that the LPs earn, and this is usually something around like 15%. So whatever fees are generated, 85% goes to LPs, and then the protocol keeps 15%, something like that. But in the case of Lifinity, because it owns all the liquidity, it gets to keep 100% of the fees. So it's like 100 versus 15, like a huge difference. And then it also doesn't have to worry about trying to attract liquidity. Uh, I guess like if we didn't have enough liquidity, then maybe that would be an issue, but we don't. We have plenty of liquidity. Actually, we have so much that we have idle liquidity in our treasury that we just haven't deployed yet. All the pools that we have all the liquidity that we want them to have. We don't want any more
That's a
because
that's a good problem to have. Too much liquidity.
indeed, yeah, there's a trade-off where um, if you deposit too much liquidity, I should say, the more liquidity you have, the more volume you're going to get. But on the other hand, it also increases your risk of impermanent loss. So there is a optimal level of liquidity. So that's what I mean when I say Lifinity has enough in all of its pools. Whereas like on other dexes, they have no like upper bound. Their goal is like infinite liquidity. You know, they always want more because that's always good for the way their dex model works. But anyways, yeah. So the protocol on liquidity is another thing that makes Lifinity quite different.
Yeah, and also I've heard that there's one other unique thing besides all of this is market making as a service, where other protocols could, or in the past, did give you guys tokens to market make for them.
Yeah. So back in the day, we wrote this article called "Market Making as a Service" and "Liquidity as a Service." And these were two ways in which we partnered with other protocols to provide liquidity for their tokens. Um, and since then, we've also had other forms of partnerships that were like slight variations on market making as a service or liquidity as a service. So, like the parameters where things can vary is one is like who's providing the liquidity. So, like it could be that we just provide the infrastructure and then the partner protocol provides its own liquidity in our pools. Was one model. Another one was where we buy the liquidity ourselves, and then we are incentivized through rewards from the partner protocol to provide that liquidity. A more recent version we did is where we borrow just their native token, pair it with our own USDC, and then market make that way. So it's like we've had various deals throughout our time with different projects, and they all look different, just tailored to match whatever the needs of the protocol are. That has been like a relatively smaller part of Affinity's market making. Um, I think that kind of thing it sort of makes more sense in a bear market, just because um, like if we're going to market make, that usually means we have exposure to the tokens that are in the pool because we hold them. And in a bear market, we tend to not want to have exposure. But in a bull market, like we're more okay with holding exposure because all else being equal, most tokens will tend to go up in a bull market. So like we're not so worried about the price of the tokens. Even though obviously like our purpose is not price appreciation of the tokens, it's to generate revenue through market making. But yeah, it just makes it easier in a bull market to it's easier for us to confidently hold tokens, even if like we don't like believe in them in over the like super long term. But yeah, that is something part of our offering.
Very cool. All right, so we've talked about MMing as a service, liquidity as a service, decentralized market making, but actually on your front end, there's basically a only a Jupiter swap integrated. Why is that, and how can someone get involved if not through your front end?
Yeah, so here's another thing that makes us unique, I guess, is that we integrate an aggregator, which is Jupiter, into our front end. The reason for this is, I guess, there's a few. Actually, people have been with us since the beginning know that our original plan was to be both a DEX and an aggregator, and so we actually had a simple aggregator when we started out. But that was like right around the time when Jupiter launched. So Jupiter launched, and we were like, do we want to compete with them and continue working on the DEX, or do we want to just focus on the DEX and then rely on them as the aggregator? And we opted for the latter, and I think that was a good decision because Jupiter, like as an aggregator, is pretty goaded. It would have
Mhm.
definitely been competition. So yeah, so that being said, we integrated with Jupiter soon after they launched, and so basically, and like from the start, we were like telling our users like our goal is to always give you the best price, and so it kind of made sense for us to integrate Jupiter into our front end, rather than just routing people just to our DEX, which does not give them the best price, not always, anyways, only when we do. Um, and another reason we do this is because we think it makes sense long term, especially on Solana, where there really is no reason anyone should be using a single DEX to swap on. Like you should not be swapping on Orca. You should not be swapping on Radium. There's zero upside. Like literally, there is not a single reason I can think of where you gain an advantage by doing that. You always, 100% of the time, do at least as good and usually better by swapping on Jupiter. And so I think that's the direction that the space as a whole is going to move toward. It's not going to like, it's not going to like, yeah, I think that whatever dexes try to compete on the front end and try to get that flow, like they're just going to gradually lose their users because, like when people realize, oh, I can get better prices on Jupiter, like they go there. But the opposite is never true. People are never like users of Jupiter and be like, oh, I can swap on Orca, or like, or oh, I can swap on Radium, and then like start swapping there. Like that never happens, right? So like the flow of people is pretty clear in my view. It's just going to go to aggregators. So just like seeing that, it also kind of makes sense for us to um, have Jupiter integrated into our front end. It's like part of like sort of an educational effort, and also just like an admission that like this is where the space is moving towards, anyways. So yeah.
Okay, thank you. So let's talk a bit about Lifinity tokens and tokenomics. You have Lifinity, X Lifinity, and VE Lifinity, which can be a lot to take in for someone new. Could you go over these?
Yeah. So our tokenomics is another thing that sets us apart. Let's see where to start. So one the I think the starting point for us was that so we have protocol owned liquidity, right? One consequence of that is that we don't need to do any liquidity mining to attract any liquidity. And this is great because liquidity mining it dilutes your token holders. And so like if you can avoid it, you definitely want to avoid it. And so we're able to avoid it. So yeah, we just don't do that. Um, so yeah, then we have this VE mechanism. So people may be familiar with the VE system that was originally pioneered by Curve, which is the leading stable swap on Ethereum. And we like that system. And we also noticed that there were a few improvements that could be made how it worked. And so we made those improvements. So basically, just to give like ELDR on the VE is that you can lock your tokens. So in our case, that's the LFNPY tokens, the Lifinity tokens. You can lock them, and that will give you VE Lifinity tokens. Uh, and the longer you lock your Lifinity tokens, the more VE tokens you get. And so VE tokens represent, in our case, we have the VE tokens are our revenue sharing token. So if you hold VE Lifinity, we distribute revenue, protocol revenue, to VE Lifinity holders on a monthly basis. Um, yeah, and so let's see. So one of the downsides of the curve model was that they had no way to um, turn the locked liquids or the locked tokens liquid. And so actually other protocols came along to provide this service to them. So most notably, there's Convex, and they created this asset, CVX CRV or Convex Curve, which is like the liquid locked version of Curve. So like you give them your Curve tokens, then they lock it forever, and then give you Convex Curve as like a receipt. But then they take a 16% fee on that, which is like really large. And so we were like, okay, that kind of sucks. Maybe we'll just do that ourselves natively, and then we won't need to pay that fee. And so that's one of the improvements we made. There's a couple other which are smaller and like not super important, but yeah. So that's how the VE tokens work. And then we did a VE IDO, which is a unique type of IDO that um, interlocks with our tokenomics. So basically, if you're familiar with like how the Mango IDO worked, there was like a few IDOs on Solana that worked very similarly to the Mango IDO. It was basically like the protocol would say, "Hey, we're going to sell this many tokens, and people can deposit however much USDC they want, and then the price per token will be determined by however much USDC was deposited in total." If it was like, let's say we're selling 100 tokens and people deposit $100, then it would be $1 per token. So in our case, one difference we made was people could deposit USDC, but they could also choose how long they wanted to lock their Lifinity for. And depending on how long, or the longer they chose to lock their tokens, the larger discount they got on their token price. And so the result of this was that I think it was 72% of VEIDO participants decided to lock their tokens. So right from inception, we had like most of our supply locked as VE Lifinity. Uh, and yeah, I think that was a great way to bootstrap like a locked supply. Unfortunately,
72% is an insane percentage, I think. And how long was that lock? Like how long did they lock it for? Were there different periods they could choose of?
yeah, so the max lock period was 4 years, and the vast majority of people locked for 4 years.
Damn.
And yeah, in the total supply locked right now, like ever since the VE IDO, it's mostly just increased. So now I forgot the exact figure, but it's like over 80% is locked as VE IDO, and most of it 4 years. Um, yeah, so like in that sense, like that's I think a pretty good indicator of like this tokenomics system is working well. So yeah, pretty happy with that.
Super cool. And what about X Affinity? Just one last question about these tokens.
Yeah, so X Affinity is related to the thing I mentioned earlier of making the liquid version, so the convex curve thing I was talking about. X
Ah, okay.
Affinity is like the convex curve of affinity. So what X Affinity actually is it's tokenized 4-year locked VE affinity. So I guess just to go into a little more detail of that, what you can do is if your VE affinity is locked for 4 years, which is the maximum, then you're able to convert that 1-to-1 to X affinity. And VE affinity isn't transferable. It's just part of your wallet, and you can't like send it anywhere. But X affinity you can, and therefore that means it's tradable. And so this is like counterintuitive to some people. It's like, what? You made it so you can lock tokens, but then you can sell your locked tokens, but then they're not locked. Like what's the purpose? But the purpose is that um or I think so the concern regarding that is that there can be governance attacks, but this is practically not really feasible due to liquidity constraints. Um, and I have a whole like Twitter thread that explains this in much more detail. Um,
Oh
but
yeah,
so,
feel free to send that in if you would like at the end or right now. Feel free to send it into this voice chat. We would love to read that.
great, yeah, I'll link it after a quick
Okay.
call.
Okay.
So, but yeah, so X Affinity you can trade it. So yeah, so I'd rather speak about the upsides, like what the point of doing this is. And the point is that so just like in theory, say like there was a user who wanted to exit their VE affinity position and they're willing to pay a tax. What if that tax was 99.99%? So they only get if they have like say like 100 VE affinity, they only get what is that? Zero point zero 0.01 affinity by exiting. As a so, and if that was the proposition as a DAO, would you like that? For me, I would be like, hell yeah, like I'll do that like every fucking time. Because like the tax is so huge on them that what they get from exiting early is like so much smaller than what we get as a DAO, which is like a deflationary mechanism, right? Like because that whatever they get taxed just returns to the treasury. So that's just a thought experiment to demonstrate that there is some price, some tax at which the DAO should be happy to let people exit even though they are locked. We should be happy to let them exit as long as the price they're paying is high enough. And so this is basically what Xfinity enables. And that price is determined by the market. So Lifinity has a Lifinity X Lifinity market where people can trade between Lifinity and X Lifinity. So if people want to exit early, uh, other people can provide that liquidity for them at the market determined rate. And I guess just to give like an idea of what this rate has been for us historically, it's ranged. I think the highest discount it ever went was something like 60%. I think that was when the FTX collapse happened, and everyone was like panic exiting, and so that was the lowest it's ever gone. And um, throughout the bear market, it usually ranged like at a very low percent, like from like 1% to 5%, something like that. And then when Lifinity increased a lot in price recently, uh, people wanted to exit because they wanted to, take profit on price having gone up so much.
Yep.
So a lot of people began selling their VE Lifinity as X Lifinity, even though the discount Sometimes Gatas has like 40%. But yeah, people are much more willing to accept that uh, tax that they had to pay because the Lifinity price had appreciated so much. There's like these interesting dynamics, but the bottom line is that at the end of the day, that it's a market rate, and the DAO benefits because actually, yeah. So one detail I didn't mention is that the DAO itself is providing a lot of this, actually, like the vast majority of this Lifinity, ex Lifinity liquidity, and the pool's fee is 1%. And then, of course, there's also discount people are paying. So it's just a huge deflationary mechanism. We've to date probably gotten like tens of thousands of dollars worth of Xfinity bought back. Or you can call it bought back, but it's been done without cost. It's like for free, just from fees. And so it's been a huge net benefit for Lifinity DAO as a whole. Uh, so yeah, my intention wasn't to like explain this in such great detail, but yeah, I think like that mechanism is actually very useful, and I hope more DAOs adopt it in the future.
Yeah, I really hope that as well, and really appreciate you going in depth. I think we all learned a lot from this, and this definitely should be a more known mechanism, especially how you guys improve the curve model, because other teams might see other improvements after this, and this can just, you know, all go to the Solana pie. So thank you for this. But talking about some deflationary stuff. Let's talk about your NFTs, the Lifinity flares, which also are deflationary. So how's the flare DAO? What's the benefit of holding one or other Lifinity flare NFTs? And how are the NFT buybacks looking there?
Yeah, so actually, we we did launch our flares before our tokens, about like 4 or 5 months before our tokens. And so we use the NFTs as a way to bootstrap liquidity as well as the community. So like our most OG community are mostly like flare holders. Um, yeah, so we took all the mint funds from the flares and we just deposited it in our liquidity pools, and that liquidity is still owned by uh, flares. So actually, the team took like we didn't take any profit from the mints. Um, so originally, it was minted in Sol, like most NFTs. And then later on, there was a deal made between Flare DAO and Lifinity DAO, where Lifinity DAO purchased all the liquidity that Flare DAO owned, and they purchased it with VE Lifinity. So now Flare DAO owns 20% of the VE Lifinity supply, which is a lot. That means Flare DAO gets like 1/5 of the total revenue, and that's used for Flare buybacks. So in the past couple of months, I think that's been like something like 500 sold per month, something like that. Um, and flares are like 10 sold right now. So I mean, at that rate, and I mean like these numbers are always changing, both revenue and the flare price. But so that's like 50 or like 0.5% of the total supply per month. So like that's the like rough deflationary force that's happening. Let's see. And then Flare DAO also has its own like separate stack of VE Affinity. And so it has like its own funding that it uses for other things. It's done a few things throughout its lifetime. It was a market maker for flares on Tensor for a while. It got a bunch of Tensor shards for doing that. Let's see, I bought some Vanta cards for Asset Dash and created like a learn course there. More recently, it partnered with Radiance DAO, which
Oh
is
yes, I've seen that.
yeah, I really like Radiance and what they're doing. So I'm really glad that partnership happened. Um, I guess I won't get into details here. But yeah, so like played out. um, has that strong deflationary force at its core. That's like the main value accrual mechanism. And then it has some of its own assets for Flare DAO to like do other things with. Uh, and like Flare DAO is pretty passionate. They're always like looking for new things to do and discussing them in the governance channels, which anyone can view in our Discord. So yeah, if you're interested, check them out.
So from the way I understand it, you and the core team are mainly or fully involved in Lifinity and decentralized market making, while the Flare DAO operates independently, like separately from you guys, and has their own governance. And as I can hear, they make their own partnerships. Is that a right assumption?
Um, not quite. So for example, the buybacks, the team executes the buybacks, and like we're currently doing those through bids on Tensor. So we just like place bids, and at least the past few months, like they've always been filled. In the past, like we've had a bot that does the buybacks. It's run by the team. Technically, the Flare DAO, what they govern is the bought back flares.
Mm-hmm.
Um, and so like I mean, just like for an example, like those flares are being used in the Radiance auctions, and whenever our bought back flares do win an auction, they get burnt. Um, but yeah, so in terms of like governance, it's I would say it's how do you say it's not like a clean cut per se. Um, it's more of a like the team listens to like what the community wants, takes polls often, uh, tries to balance the views of different community members. Often, like it's fairly unanimous that like Flare DAO wants to do something. Sometimes it's much more contentious, and that makes my job much more difficult. um, like because I don't want to make it where it's like, well, okay, well, 51% voted yes, so we're gonna do it. Because I don't know, that seems like much too simplistic. Ideally, you want a much larger majority in favor of something before like going forward with something. Otherwise, like you risk splitting the community in a major way. That could be very bad for the FLIDA. So yeah, so the governance is kind of messy to be honest, but I think that is good. I think it is actually better, at least right now, than just doing like straight up like token voting, or in this case, like NFT voting, like voting weighted purely by the number of NFTs you hold. Um, I don't know. I think success cases for that kind of DAO management are very rare. So
Yep, agreed.
yeah, so as messy as it is, I think for me, anyways, and I think for most Flare DAO members, they're happy with how governance is done in this messy way for now.
Very cool. Moving on to more recent happenings, you guys had 100% consensus to move Lifinity USDC and X Lifinity liquidity to Meteora, which is a insane, and be on top of the fees earned. You are also earning a big portion of the Meteora incentives, and I know you have been one of the most active contributors in Meteora. I've been in a few town halls with you myself, so I'm wondering what your thoughts are on Meteora's points program, and if I, as a user with Lifinity holdings, should be depositing into this Lifinity pool, or what is the best way to gain exposure?
Sure. So yeah, I think the Meteora points program is cool. Um, I actually suggested that they much more heavily weight fees over points. But uh, yeah, they I think, yeah, so in my view, they're not weighting fees as heavily as they should. It's probably like not a huge deal. But anyways, that is definitely beneficial for Lifinity because the liquidity that Lifinity deposited is like very large in terms of TVL. It's like total of I think it's 4 million, which is like a lot. It's like 4 million points per day just for
Yeah,
having your asset on Meteora.
yeah.
Um, but in terms of fees, like it's not generating that much. It's not capital efficient. It's just like a constant product tool. So because of that, like the this model where fees aren't so heavily weighted actually does favor Affinity pretty well. So I mean that's nice for us. In terms of like whether you should deposit, um, I don't think you should deposit for Affinity USDC because so I mean basically the reason we provide liquidity for that is like as a service to our holders. It's not because we're trying to make a profit. Like it's just that like very few people want to provide liquidity for Lifinity USDC because, like I said, there's like not a ton of trading volume, and I think it's safe to say that in most cases, like the impermanent loss will be greater than the fees you generate, and that's why I say like we're doing it as a service, not because like we're trying to make a profit off of it. On the other hand, for Lifinity, X Lifinity, I think that is a pool that has potential to generate revenue for yourself. But if you want to compete with like the massive liquidity that is Lifinity's Lifinity X Lifinity liquidity,
Hmm.
the way to do that might be through concentrated liquidity, and our liquidity is just in a constant product pool. So like it's very low risk because like X Lifinity and Lifinity are like strongly correlated to each other. Like you can always freely convert Lifinity to X Lifinity for free. But the other way is not true because to turn X Lifinity into Lifinity, you need to unlock it over the course of 4 years. So X Lifinity will always trade at a discount to Lifinity, but we don't know what that discount will be because it's a market determined rate. So I don't know, it's kind of tricky. I mean, if you want to earn Meteor points, I would say focus on other assets, like because like Lifinity, X Lifinity, like there's some potential there. But on the other hand, like if you hold X Lifinity, that means you're missing out on the protocol revenue because you have to convert your X Lifinity to VE Lifinity to
Hmm.
start receiving the protocol revenue. So like that's just much simpler, right? You know, you convert it to VE Lifinity and you start receiving revenue. You don't have to think about like the complexities of like what's the rate going to be, how's it going to change, how fast is it going to change, and who are my competition and all that. So yeah, I think I would recommend like um, trying to use their DLMM. I mean, especially if you're a programmer, but even if you're not, like I would try to use it like opportunistically. So for example, like with the Jupe launch, which is when the points program launched. I mean, there's just like so much volume on Jupe, and so if you were providing liquidity on their DLMM, there's like a very good chance that you made money even after considering impermanent loss, just because there's so much trading activity. And so like those times especially, so like new token launches, for example, or like when Meteora is giving like a points bonus, probably like also a good time to try things opportunistically. And if you want a more hands-off approach where you don't have to think about the range to concentrate in, then it's probably better to just use their constant product pools. Um, yeah, just because those are simpler, but probably choose the pools that are like stable pools because um, like you're not going to do well on a full USDC um, constant product pool. Just like tons of impermanent loss, but like almost no fees because you're not concentrated. So yeah, I hope that's somewhat helpful.
Definitely, and agreed. Appreciate the advice, sir. Um, and so, sort of lastly, before I open up to the community for some questions, you've been giving out hints about Project S, but at the Oligarch Roundtable, we just love to squeeze out more alpha than what's available out there. So, what could you let us know about Project S? What will it roughly be, and sort of when can we expect anything regarding that?
Yeah, I'm getting tired of having to withhold information about Project S
It's
because
time. It's
you
time
know,
to tell it now.
yeah, the questions never stop. But yeah, so Project S is a new protocol we're working on. We can't yet say what that protocol is, but maybe some things we can say is it will have strong potential for integration with the tokens of other protocols. Um, let's see. What else can I say? So I guess in terms of development, it's been under development for a few months now, and we're currently in testing. So if things go well, we will do our initial launch this month. Fingers crossed. Uh, yeah, I guess I think that's probably about as much as I'm able to share right now, fortunately.
Okay, thank you very much. We are definitely looking forward to it. So I have one last question, but before I ask that, I want to open up the stage for the community here. So guys, if you have any questions for Durden, now is the time to unmute yourself and ask it.
Hey fellas, quick question for me. If we want, like, with this Project S, how is it best for us to be able to interact with it? Like, how would we look to participate?
Um, uh, you mean other than like after we launch and you can actually use it, or
Yeah, correct. So essentially, yeah, that's my question. Is it going to be simply like a simple case of like it's a DApp that you can use and interact with, or is there something more that we could engage with?
yeah, it's basically going to be a DApp that you can interact with. Uh, yeah, it'll be a DeFi app. So yeah, it'll be like like how you use other DeFi apps.
Okay, cool. Cheers. And then in terms of like I'm a bit dim, so still trying to get my head around the VE Lifinity and the X Lifinity and stuff like that. So again, if we wanted to uh, like interact with those tokens and look to like seek to invest in them, is it a simple case of like if we hold the VE, we would receive essentially the price appreciation and the rev share from there. Whereas if we hold the X Lifinity, is it same but different or?
Yeah, so I just posted the Twitter thread I was talking about in the chat, by the way. Yeah, so in terms of price appreciation or like whether you have price exposure or not. Yeah, so basically you do. It's like you have Lifinity, the base token, then VE Lifinity is just a locked version, and it can have various lock periods. The longest is 4-year VE Lifinity. And so that just means that if you unlock the VE Lifinity, then over the course of 4 years, your tokens linearly unlock. And so like that VE Lifinity still contains the underlying Lifinity. It's just that your access to it is gated by time. And then X Lifinity is just the tokenized version for your VE Lifinity. So same thing for that. Um, it it does have the price appreciation baked in because it still contains the underlying Lifinity. With the one caveat that if you want to immediately sell your X Lifinity rather than waiting the 4-year unlock period, then you have to pay the market rate, the market discount for, or I should say premium, market premium for the early exit, instead of unlocking your tokens gradually and then selling them. It's like you get to sell it all at once without waiting the lock period, but yeah, you're paying the whatever the market premium is at that time.
Right, gotcha. Okay, I understand that. Wonderful. Thank you, mate.
No problem. Appreciate the question.
All right, if there's no more questions from you guys, I will go ahead with my last since we are approaching the 1 hour mark right here. So, Durden, since you are very deeply involved with DeFi on Solana, what would your advice be for someone who is at the beginner level with some experience but wants to double down on this niche? Should they learn Meteor or the LMMs, arbitrage and borrow opportunities between platform, or what would your personal suggestion be?
Interesting. I haven't thought about that in a while because yeah, it's like once you're in like DeFi for a long time, your perspective changes a lot, and it's but like thinking back to what I started doing at the beginning, like while it did wrecked me in a few ways for sure, I think that's probably just like part of the experience. So I would say branch out and try a lot of things. I mean, like I think also needless to say that the correct answer to this depends on your size. So like if you're smaller in size, then I think you should be willing to take on more risk. So for example, like if you're not like worth millions, for say, then like you probably don't, or no, yeah, if you're not worth millions, then like you should be thinking about um, like trying leverage in certain ways, especially through like lending protocols. I used to do a lot of this kind of thing when I had more time, um, but like taking on uh, not insane leverage, like very like low amounts of leverage. So, for example, you deposit on Camino, and you're getting the lending yield, and you're also getting the points. And then you borrow some asset where you know that you can lend that asset somewhere else, but the lending rate on this other protocol is higher than the borrow rate on Camino. Then you get more points for borrowing. And then you also get APY, which is the lending minus the lending on the new protocol minus the borrow on Camino. So then you get more there. So like stuff like that. You have to pay attention to like the rates to make sure you don't get liquidated. And that's why, and I do think you should use like again like low leverage where you're like pretty pretty confident that like price can't move X amount within whatever frequency it is that you check these things. Like if you check like every 24 hours and say, I don't know, like I probably shouldn't give examples and say something stupid. But yeah, I think you get the point. So like I think doing that kind of thing can be pretty effective. And then I'd say like try lots of things. So if you're like totally new, I guess first of all use Jupiter. Swap into a few assets that maybe you find interesting. Twitter, obviously, great resource to like start finding out about new protocols and stuff. Once you swap some stuff, maybe try providing liquidity. I think Meteor right now is a great place because they have points. Um, I guess there's some other like Radium and Orca also have some incentivized pools, but those are uh, like in terms of like total incentives, it's less on those protocols. So you have to look on a pool by pool basis to know like what's best. But so you could do stuff like that. What else? And then yeah, like lending protocols. I feel like lending stuff is pretty good because like impermanent loss can be like pretty hard to understand and also like strategize around. Whereas like lending protocol stuff, I think it's much simpler to understand. So yeah, I don't know. Those are some thoughts, some jumbled thoughts.
Well, thank you very
Oh,
much.
thank you very much.
Any any thoughts from you are highly appreciated. And I think we've come to an end now. Very deep combos, and I feel like I know Lifinity a lot better, especially the tokenomics. So thank you very much, Durden, for coming here and explaining everything. We really appreciate your time, and we look forward in the future if, for example, when Project S launches and you'd like to do a demo or anything like that, maybe in a another time with even higher attendance, we would love to have you again. And yeah, once again, thanks for hopping by.
Yeah, thanks for having me on. Good questions. I had fun, and yeah, that'd be fun to come back on for Project S once it launches.
Excited. All right. Thank you. Cheers, guys, and have an amazing rest of your day.
Cheers, guys. Thanks for joining. See you guys around.
Thanks
Peace.
for coming.
Thanks, mate.